That is why we have experienced, dedicated healthcare business bankers who specialize in the industry. Our healthcare business bankers earn board certification as medical practice executives from the MGMA, which helps enable them to better understand both the external and internal factors that practices face today, to have a consultative diagnostic conversation to help prescribe ways to streamline your practice operations and optimize your revenue cycle. I'm excited to say that we do have healthcare business bankers in New York, Virginia, West Virginia, Pennsylvania, and now Connecticut. If you would like to learn more, I would encourage you to reach out to me and I will connect you to the local healthcare business banker in your area. I would now like to introduce everyone to our presenter, Bill Adams, who is a senior economist at PNC's Financial Services Group. Bill, the floor is yours.
Thanks, Brian. Good afternoon, everyone. It's a pleasure to be with you, at least virtually. I ordinarily, when I am invited out to speak to luncheons like this, I sit down with a group of people from the hosting organization. And although I wasn't able to do that today, I kind of feel like we shared a meal virtually, because I had leftovers, and I suspect at least some of you had the same meal. So I feel in that way, I feel like we've shared something even before we began today. I am part of the forecasting team at PNC. My team has a couple of functions within the bank. We forecast our baseline economic outlook for the US and global economies, meaning that we lay out what we think is the most likely path for where the economy is headed over the next 2 years or so. And separately, and as an internal function, the economics division at PNC works with other teams to plan for, to imagine severely adverse scenarios that could happen to the US economy. And what would those scenarios be like, and how would they affect our bank and the financial system more broadly, to ensure that PNC is prepared for when a crisis that seems extremely unlikely strikes the bank. And it's not just our bank, but strikes the US and global economy generally. These jobs have sort of converged in 2020. And so a lot of our thinking this year has been not only what is this very severe recession doing, but how is this very severe recession different from how we imagine very severe economic downturns playing out. And this, I think, really captures, this slide in front of you really captures for me how different this downturn that we are in right now is from anything we have on record for the US economy. The decline in economic activity in February, March of this year, we had a sharper drop in economic output, which in this slide is measured by the number of people working at American employers, as measured by the Bureau of Labor Statistics monthly establishment survey. So that we had a larger decline in employment than we've ever had on record. The drop in employment over the course of this downturn, over the first 2 months of this downturn, was larger than the drop of employment during the Great Recession of 2008 and 2009. That's the green line on the chart in front of you. That drop in employment happened over almost 2 years, versus in this downturn, we had all of that happen in just 2 months. So really, we went through a shocking decline in employment as the economy shut down. And then in the subsequent months, we've had an unprecedented recovery of employment in the data through the month of August. We now have made up about half of the jobs, just under half of the jobs lost over the first 2 months of this economic crisis. And so we've had an unprecedented downturn, an unprecedented recovery starting. And so on the one hand, as an economist, I feel reassured about the US economy in that we are seeing employment bounce back, recovering much faster during this downturn than in any previous recession on record. But this is really kind of a two-handed economist. I have to hold my hands up a little higher for them to be in the frame, I guess. Two-handed economist kind of a moment, because on the one hand, we have this strong recovery underway. On the other hand, the level of employment that we have right now relative to, and I hope you can see my cursor here, the level now relative to where it was at the worst of the Great Recession, which was prior to this downturn, the most severe recession that we had on record in this data. These data go back to 1939. We're still worse off in terms of the level of employment than we were at the bottom of the Great Recession. So we have a long, long, long ways to go to get back to a normal economy. And that is all, as preface, is a way to say that as economic forecasters, we can't really rely on the historical record for how economic downturns usually play out to understand what's going to happen to our economy next in the United States. A big part of this, and one of the pieces of very good news about the economic outlook is that we've had unprecedented fiscal stimulus, unprecedented spending by the federal government to support the economy, cushion the effect of the downturn in the spring months, and to get the economy back on solid footing. So the stimulus plans that I've kind of aggregated up in the chart in front of you. The Families First Act, that was the funding for paid leave for people who have to take leave from their jobs because they are infected with coronavirus. The big one, the CARES Act, the $2.2 trillion stimulus bill in March that funded the $600 per week unemployment insurance benefit for workers who either their employers went out of business, or for most workers, their employers were forced to shut down during shelter-in-place orders. And so there's the unemployment insurance for workers, the expansion of unemployment insurance through programs like the Pandemic Unemployment Assistance Program, which allowed many, many more workers who wouldn't have qualified for unemployment insurance prior to this crisis. Workers like independent contractors are now eligible for unemployment assistance in the United States. And then aid to businesses through the Paycheck Protection Program, and then also funding for the Federal Reserve to extend credit to the private sector, make loans to large, medium, and small businesses through its corporate credit facilities and Main Street lending facility and asset-backed securities lending facility, the term asset lending facility. So all of that is just an unprecedented amount of cash funneled into the real economy. Phase 3.5 adds in additional funding for the Paycheck Protection Program. And then the executive order, this is the order made by President Trump's administration at the end of July, authorizing FEMA to pay $300 per worker in compensation for unemployed Americans to workers whose $600 per week unemployment insurance benefit expired at the end of July. So all of that added together, we're looking at about $3 trillion in total fiscal stimulus in this plan. That's nearly 15% of the output of the US economy in 2019 before this crisis struck. So an incredibly forceful collective action by the federal government that is putting this recovery on a much faster recovery trajectory than we had out of the Great Recession. In the aftermath of the Great Recession, the federal government tightened its belt, cut spending. There were tax increases as fiscal policy tightened. That slowed the course of the recovery. Right now, we're experiencing the opposite, where very, very aggressive fiscal stimulus is putting cash in consumers' pockets and supporting businesses and allowing them to recover faster than we had last time around. The second aspect to the stimulus, and I think probably, we would have been we could have been in a very bad situation in terms of the financial markets and financial sector if we hadn't had this. The intervention by the Federal Reserve. The Federal Reserve in March cut short-term interest rates to near zero. They relaunched their quantitative easing program. This is when the Fed wants to provide additional support to the economy. And after cutting interest rates to zero, they want to stimulate the economy further. So the Fed buys Treasury securities, the debt of the federal government. The Fed buys more the debt of the U.S. Housing finance agencies, Fannie Mae and Freddie Mac. And so indirectly, by buying those securities, the Federal Reserve is pushing down interest rates on benchmark long-term debt in the United States, which then spills over to more credit available for private sector borrowers, and that credit is available at a lower interest rate than if the Fed had not intervened. So the Fed expanded its balance sheet from just under $4 trillion prior to this crisis to over $7 trillion in the latest data for the beginning of September. And this is far more aggressive than the Fed's intervention in the Great Recession and in the financial crisis of 2007, 2008. And the Fed, in addition to its purchases of government securities and government guaranteed securities that I just mentioned, the Fed also, in partnership with the Treasury Department, set up the lending facilities that I mentioned earlier, talking about fiscal stimulus, where because the Treasury Department and because Congress has allocated money for the Treasury Department to fund the Fed's purchases of private assets, the Fed is now able to go out and buy bonds issued directly by companies who weren't able to get financing during the financial turmoil of March and April. The Fed also is able to buy the bonds of local governments, buy bonds issued that are that indirectly channel credit to small businesses and to consumers. And then, as I mentioned before, the Fed is channeling cash into the housing market by its purchases of agency-backed debt. So this massive intervention from the Federal Reserve has pushed long-term interest rates in the United States down to record levels and is a big part of why the US financial system has come through this crisis without major bankruptcies of financial firms, without the kind of financial turmoil or sudden stop in the financial system which we experienced in 2007, 2008. You don't usually get credit for the crises that don't happen, but I think this year, this is worth noting that the intervention from the Federal Reserve supporting the financial system, as well as the financial system just being far better prepared for a crisis in 2020 than it was in prior to the global financial crisis of over 10 years ago, that has really made it more possible for us to have a faster recovery this time around. So that is the good news. The bad news is that we have also had an unprecedented plunge in employment, which I laid out in the slide before in its historical context. But this, plunge in employment, it's very uneven across the different sectors of the economy. Healthcare is known to be the recession-proof industry, and that is, it's less true this time around than it has been in previous crises. Looking at employment of healthcare professionals and technical professionals and healthcare practitioners, so doctors, dentists, registered nurses, the unemployment rate did tick up slightly during the shutdown in the spring. It's come back down to a level that's higher to what we had prior to this downturn, but still very low relative to other sectors of the economy. But the unemployment rate for healthcare support occupations, these are home health aides, health nursing assistants, and related roles. That unemployment rate rose to over 10% during the economic shutdown, and it's still near 10% in the latest data for August. These data are noisier than the headline jobs report data that you hear about in the monthly jobs report if you follow those, but this gives us a much more granular view of what's going on in sector by sector in the economy. So even in the healthcare sector, we are seeing a pretty sharp impact of the economic downturn. However, on the right side of this chart, you'll see that that just doesn't compare to what's happened in the most heavily impacted sectors of the economy, which is the hospitality sector, food service, restaurants, bars, the travel industry, the retail sector, the daycare service providers in the United States. Those sectors have seen unemployment rise to really unprecedented levels. It's, you know, as a macroeconomist, looking at that chart and seeing that the unemployment rate was over 40% for food service workers in the month of April, that's just, it would have been unimaginable a year ago to think of unemployment being that high. Even with the sharp decline that we've had into August, we still have very, very severe unemployment affecting those industries that really, the industries are, it's difficult to function without bringing the pandemic under control and without the end of the necessity of social distancing measures. So on a broad view, again, across the economy, you know, where are we right now? This is a chart that I use to think myself of where we are and where we're headed. The orange line in this chart is consumer spending, where we had a very sharp drop as shelter-in-place orders were imposed, and then we've had a strong recovery in the subsequent few months as the economy has been allowed to reopen, as people have felt safer venturing out of their homes and going back to more normal activities, and as things have started to progress back towards a more normal situation. The green line is the, I mean, it's just bizarre relative to how the economy usually functions, which this is the, this is household income in the United States, personal income, and it has actually increased over the course of the economic shutdown because the tax rebate checks, the $1,200 checks to households, as well as the unemployment insurance benefits paid to unemployed workers caused personal income to increase even as employment was plummeting in the spring months. And so with that happening, we saw the household saving rate in the United States, which is, you know, the share of monthly income that is not spent in consumer expenditures, measured in aggregate, not measured household by household. That saving rate has risen to the highest on record, more than twice as high as its historical record level back in the 1970s in the month of April. Coming down sharply in the latest data through July, but still very, very high on an historical basis, demonstrating, number one, that household incomes have held up over the course of this downturn, and number two, that household spending behavior is a long way from normalizing. And there's a lot of room for households to increase their spending, assuming that income doesn't fall further, and to support the recovery going forward. The reason, or the composition of this recovery of household spending, I think, is quite unique. Since the pre-crisis peak in consumer spending in the first few months of this year, we've seen spending on goods, meaning you know, purchases at grocery stores, spending on gas, household appliances, car sales, boat sales, all of the sales of exercise equipment over the summer months, all of the things that people were spending money on because they were spending much more time at home. And because they had more, for many households that either were retired or where they felt their employment was secure, they had additional disposable income with these tax rebates from the federal government. And so it fueled a lot of consumer spending in the last few months. So spending on goods by American consumers is already above where it was in the beginning of this year, which is good news for the economy. That's a big tailwind for this recovery. Spending on services is a totally different story. And there we see the impact of the fear of the pandemic, as well as government restrictions on activity, holding back the recovery of tourism, spending at restaurants, movie theaters, concerts and sporting events, any number of these ways that people spend money on experiences. This is the part of the economy that is having a much harder time to recover. At the risk of stating the obvious, this is a part of the economy where we're not going to see a recovery until the pandemic is brought under much tighter control. This is going to be a slower part of the economy to get back to normal than spending on goods. We can see this in more detail in the monthly data on retail sales in the United States. Retail spending at food service and drinking places, again, restaurants, coffee shops, bars, down by nearly 20% year over year in the month of July. Spending on non-store retail, this is e-commerce largely, up by 1/4 year over year, huge growth. And spending at grocery stores, also up by more than 10%. As those essential businesses stayed open during the downturn. And we've seen that this change in consumer behavior where people feel comfortable going to those essential businesses and they're used to it, and changes of behavior tend to persist over time. That is a sign to me of how the unanticipated changes brought about by this downturn are going to have long-lasting effects. And so a much faster transition from a brick and mortar retail economy to an e-commerce economy, sharply affecting consumer behavior. We don't have high frequency data on healthcare spending in the same way, but when it becomes available, I'm expecting to see the same trends in spending on telehealth versus face-to-face medical services, where telehealth, grew tremendously over the last few months, and I think even as traditional healthcare delivery channels become more feasible, we're still going to see telehealth playing a much larger role in our economy than it has prior to this downturn. Now, where do we see specific sectors of the U.S. economy going forward? On American industry, on American manufacturing, we have actually quite good news for the auto sector and from the auto sector. So auto sales plummeted like everything else during the economic shutdown, or almost everything else during the shutdown in March and April. And then actually auto sales have seen a very sharp recovery in the last few months, which is fueled by the stimulus payments to households, fueled by record low interest rates that flow through to very low rates on car loans, and fueled by if you think back a few slides, and I'll go back to it, the unemployment slide, looking on the right-hand scale, the unemployment in food service, unemployment in the personal care and services, those industries that have had the hardest hit from this crisis also tend to pay lower wages than the average in the United States. And so the households in the US that that buy most of the cars sold in the United States, those households have come through with far less damage to their savings and with far fewer job losses than lower income households where workers are more likely to be in those hardest hit industries. So that's been good news for auto sales and good news for the auto sector. And that's one of the reasons why we're expecting strong auto sales to persist through the end of this year. Auto inventories on car lots are low right now. And after the shutdown, both on auto sales, but also on production, there is a lot of demand just to get inventories back to normal for the auto sector. And that's going to drive a recovery of related manufacturing industries over the rest of this year. Even with that being the case, we think that overall industrial production, the orange line, is going to have a weaker recovery than many other sectors of the economy. And the reason for that is that a lot of industry in the United States is closely related to energy and petroleum. and oil prices plummeted early this year. It seems like ancient history now, but thinking back to February and March, there was a conflict between the major oil producing countries, the OPEC member states, where they held off on production cuts to either to punish for Saudi Arabia, to punish Russia, or maybe to punish US producers, or maybe both. And that happened just as global demand for energy was plummeting because air travel was grinding to a halt. So we saw energy prices fall to record lows during this crisis. Actually, one of the closely followed futures markets for oil, went negative one day, which is more related to short-term issues in how the market is structured than to supply and demand. You can see it in this little gap in the chart. I cut it out because it's just so much of a distraction to see oil go down to a negative price. But even excluding that, we've had extremely low energy prices this year that persist, to today. The price of WTI crude, which is the benchmark price for oil produced in the United States and sold in the United States, is under $40 a barrel. That's a price at which American energy companies do not find it profitable generally to expand investment, do not find it profitable to hire additional workers, and so are not going to be buying more capital equipment, not buying more trucks or drilling rigs. And so that is going to spill over to reduce demand for all sorts of manufactured goods and capital goods produced in the United States. So the bifurcation now in the US manufacturing industry, where the auto sector looks like it's doing well. The aircraft manufacturer, for obvious reasons, is going to have a very slow and difficult recovery. And then the energy industry is also going to be a major headwind. For other, looking across other parts of the economy in construction, we can see the same sort of winners and losers. Look down here, this is like the names of all of these activities that require people to be gathered in close groups. Private schools and universities, we're seeing construction spending fall year over year. Offices, construction spending is falling. Manufacturing is as I mentioned, is in a difficult state. Lodging, hotels, religious organizations, all of these groups are the ones that are really bearing the brunt of this economic downturn. And that's where we're seeing the concentration of the drag in the economy. And it's where it's going to take much longer for those sectors and those parts of American life to get back to normal. Very different story for other parts of the economy. Healthcare investment, healthcare construction spending is actually up a little bit in the data for July, up 1% from a year earlier. And then many other types of spending related to public services and public health are up in year-over-year terms. Overall, construction is about flat, but really big differences among the components. In the residential real estate sector, this is a part of the economy that's actually doing quite well coming out of this recession. These are the leading indicators that macroeconomists monitor to see the outlook for the housing investment and housing demand in the United States. Home sales already have recovered not only to higher than their peaks prior to when this crisis hit, but have recovered to the strongest levels that we've seen since the end of the housing bubble in the middle of the first decade of the 21st century. So this is another way in which the crisis has transformed the economy. The Federal Reserve has pushed mortgage rates to record lows. Stimulus payments have meant more cash in hand for many American households. Households that are higher income and have more wealth and savings also tend to own more stocks, and the stock market has recovered to record highs. And all of that has meant more purchasing power for home buyers who tend to be above average income, above average wealth in the United States. And so that is driving housing demand. There's another very important factor at play, which is the impact of the pandemic on where people are choosing to live and how they're choosing to live. And this is a topic that is, on the one hand, very important, and we can anecdotally see it playing out in the housing market. But on the other hand, there's no statistical data on it. So as an economist, I don't want to ignore it, but I also don't want to pretend I know more about exactly how it's working than I do. But anecdotally, I personally know people who were living in large cities prior to when this crisis hit and are now are outside of those cities. Either the people who I know, it's temporary, but there is also a documented move of housing demand out of the urban cores and into the suburbs and smaller cities in the United States. So again, I don't have a lot of data to work with to be sure of what's the composition of this, how is this playing out exactly. My working hypothesis, my best guess, is that what we've seen in this crisis is housing demand over the next few years has probably been pulled forward. So if you were living in a major city, renting, living in an apartment, have been thinking about moving to the suburbs sometime over the next 3 or 4 or 5 years, but the timing wasn't quite right, this wasn't the right moment, I think you're the sort of person who would have been making this move, would have been driving this recovery in housing demand. And that aggregated across the economy, accelerating all of those housing sales is why housing is one of the sectors that's leading the economic recovery, and one that we think is going to continue to lead the recovery with interest rates very low and the household savings, which one of my first charts at record high levels. So from a high level view, it looks like we are headed towards a faster recovery than we saw from the Great Recession, but a very uneven recovery where some parts of the economy are growing quite well. You know, in some, like housing, activity is actually above where we were prior to this recession, but other sectors are going to take much longer to recover, and the economic pain is going to be longer lasting and harder to deal with. There's also going to be a very important regional disparities coming out of this crisis for the same reasons. Areas like the Las Vegas metro area, Florida, tourist economies, Hawaii, very, very hard hit during this downturn. The other areas where tourism is less important, that is less of a concern. And energy dependent parts of the US, Louisiana, Texas, the Midwest oil producing states, Oklahoma, South Dakota, those are areas where we're also going to see a drag from these more persistently weak industries. But on the whole, we think the US economy is going to continue to improve. The unemployment rate peaked at 14.7% in April of this year. It's come down to 8.4% in the latest jobs report for the month of August. We think it will continue to fall through the end of this year slowly. We're going to see a slower pace of job growth. Number one, because some of the job gains in the last few months were just businesses reopening and bringing workers back, and not adding new net jobs. Number two, because many of the jobs added just in the month of August were temporary hires for the census, and those census jobs will go away. And then number three, because many businesses that closed during the shutdown and have now reopened, over time may find that it's not viable to stay in business with the continued drag from customers' fears about being out in public. If 60% of consumers feel safe going to a movie theater, but 40% of consumers don't, and the movie theater operates at 60% of its pre-crisis capacity, it's easy to imagine that would be unsustainable for that or for many types of businesses. So I think we're going to see more permanent business failures in the 12 months ahead as businesses figure out what works and what doesn't work. And we'll see more workers across the U.S. economy who go from being temporarily laid off or thinking that they're temporarily laid off to realizing that their job losses are permanent. They'll have to find a new job either with a different employer or in a different industry, and that will slow the pace of job gains and slow the recovery. So we are thinking that we'll see the unemployment rate continue to decline, but probably still be above 5% at the end of 2021, which that's no longer a disastrous level of unemployment, but it's not good. That's nothing like the hot job market that we had in 2019 and early 2020 with the lowest unemployment rate in 50 years at 3.5%. We think we'll have above trend GDP growth as the economy gets back to normal over the next 18 to 24 months as that happens. But we also see risks, more downside risks than upside risks, more ways that the economic outlook could turn out worse than our most likely outcome than turning out better than that most likely outcome. And those downside risks, I think number one is from the pandemic. If we see a second wave of infections, if governments are forced to reinstitute restrictions on activities, or if people just decide that they don't feel safe going back to normal activities, then that will slow the pace of recovery. It'll slow the recovery of those most sensitive industries like tourism, restaurants, retail, and so forth. And that will mean a weaker recovery and a longer period of time before we can get back to normal. And then also the outlook for fiscal stimulus is going to be a big determinant of the recovery. And it's a way in which this recovery could turn out to be slower than our baseline forecast. We are assuming that we see another stimulus bill out of Washington. And without that, we're likely right about at the end of the additional $300 per week of unemployment insurance benefits that are being paid by FEMA. And without those unemployment insurance benefits, we're going to see personal income falling in coming months, and that will be a drag on the recovery and will prolong and deepen the pain of this recession, especially for households that had less income coming into the recession and didn't have savings. So that is a major downside risk that we're facing as well. But in the base case, we do think that we are headed back towards a more normal recovery over the next few years. The level of GDP, the level of economic output getting back to its pre-crisis level, probably by early 2022. Inflation, I mentioned earlier, energy prices are at very low levels. That holds down overall inflation in the United States. We have seen inflation in a couple of pockets of the economy driven by shortages of personal protective equipment, shortages of toilet paper, shortages of lumber used in the housing industry. But those shortages, to my mind, are really driven by very specific dislocations in supply chains and not by overall mismatch of supply and demand. On the whole, demand in the US economy is still weak with the unemployment rate still at 8.4%. And we think that that's the more important determinant of inflation over the next few years. We think that CPI inflation will stay under 2% measured on an overall basis throughout 2021. And if you look at the trend in CPI inflation, which you can get by excluding fluctuations in energy prices and food prices, which tend to be the most volatile components of inflation, it looks like inflation will get back to more normal levels of at or a bit above 2%, not until 2022. For interest rates and for financing costs, that means that we expect long-term and short-term interest rates to stay extremely low for several years. The Federal Reserve at the end of August made a change to their strategy in setting interest rates, where they said that prior to August, their aim had been to ensure maximum employment in the United States and to also have stable prices, which they define as inflation of 2% as measured by the price of all goods and services that Americans consume. And so that 2% inflation target, if you're willing to use the term, had been what the Fed had aimed for prior to August. But in August, looking back over the whole course of the expansion prior to this recession, which the expansion began in mid-2009 and then ended in February of this year, inflation actually averaged under the Fed's 2% aim for that whole period, because although they got it to 2% for short periods over that long expansion, that was the longest expansion in U.S. history, going back to the mid-1800s. Over the course of the whole expansion, it averaged under 2% because inflation was below the target for many years and only at the target for a few years. And financial markets right now, there are financial instruments that you can use to find the implied inflation rate expected by financial markets. And during much of the heading into this crisis and then during the aftermath of this current recession, expected inflation has fallen under 2%. So the Fed has now changed their strategy and said that we not only do we want to achieve 2% inflation, we want to make sure that inflation averages 2% over time. So meaning from the beginning of this recovery to the beginning of the next recession, whether it be 18 months from now or 10 years from now, we want inflation to average 2%, which means that since inflation has been below 2%, is under 2% right now, we want it to be over 2% at some point in the future. So their current phrase is moderately above 2% inflation. And what that means is that lumber prices have surged in the United States and the Fed doesn't care. There are these other little pockets of inflation in the US, the Fed is going to look past them and say that as long as the trend in inflation is under 2% or even at 2%, we still see room to continue to support the economy with extremely low interest rates. And so in our latest forecast for the Fed's policy rate, the federal funds target, we have the Fed keeping interest rates, their policy interest rate next to zero until 2024. And asking an economist what their forecast is for 2024 is kind of like, you know, asking me, what's your plan for dinner on November 5th? I don't have a plan for dinner. That's a very long time off to generate a forecast. And so the economic saying that we're not expecting a rate hike until 2024 is another way of saying we are very, very far from the type of economy that would justify the Fed to raise interest rates, and we don't think we're getting there anytime soon. With that being the case, we also think that long-term interest rates in the United States will stay very, very low for the next few years, although probably head higher as the recovery unfolds. With that, I am going to hand over to my colleague Mike to talk about capital markets and PNC's capabilities in investing. So Mike, I'll hand over to you now.
Hey, thank you so much, Bill. And I greatly appreciate everyone's time on a Friday, given how busy everyone is and time being the highest commodity. Greatly appreciate lending the ear as we exit our work week. And in regards to that, really wanted to start by thanking everyone for their time, but also circling back to what Bill has uncovered in the last couple of minutes here to educate our folks, but also how that means to us as an individual. And really, in covering this slide in front of us and before diving into it, really the goal of these three slides that I will cover is really to build confidence. And one of the questions I get in my career here at PNC, funny enough, is what does PNC stand for? And really what we are actively trying to do today, my answer is always PNC stands for People Need Communication. And that's what we're trying to communicate to you and to our clients and to our prospects is really in a time of uncertainty, We really want to communicate to our clients to make sure that they are focused on their goals and objectives and not really make any drastic decisions based on what is happening around them, given what is happening around them may not be something that any of us can control, but we can communicate together to make sure that we are staying on track. And recently, I've changed that answer from PNC, standing for People Need Communication, to People Need Confidence. And our goal out there is working as an individual or as a business banker to help support your needs. We are focused on building that confidence. So hopefully in Bill's discovery today and lecture in regards to updating us on the economy and where we are and where we're prorated to be, we want to focus on making sure we're building confidence. So if there's any red flags or concerns that may have arrived and you are failed to be receiving those from our financial advisors that are currently representing you or any banking, we want to be here for you. And following this presentation will be all of our contact information, be happily available to answer any follow-up questions during our Q&A. But without that plug, moving next into the presentation you see in front of us, very common asked question that I thought would be relevant in today's presentation is really the 20-year daily returns ending as of the end of August. These numbers displayed in front of you really display that there is no crystal ball. There isn't a financial advisor out there, or somebody that's going to be playing the market that is going to effectively, outpace what the historical average display for you. And the visual that we show here in front of you is showing the initial growth on a $10,000 investment in the right-hand column. In the center column there is showing your percentage. So if you were to not touch that investment and just invest over the 20-year long period of term, you would be, pretty positive in, looking in the right direction to achieve your goals and objectives. And really trying to play that, and in playing so, not knowing how to forecast or not having your finger on the heartbeat of the market or being able to predict a pandemic that we had earlier in Q1 and Q2, you'll see a missed opportunity, and a lot of individuals that decided to get out of the market earlier this year really lost in the capture of the uptick in the rebound of the market. And that displays in the figures below. If we go into the next slide, it really identifies some key takeaways in terms of you personally as a saver. Not only you personally, but you as a business owner, and really understanding how the market reacts to volatile times. In identifying these 4 takeaways, and you can read them at first, I don't need to read them to you, but in reviewing them, I want to make sure that you are personally aligning them to your goals and objectives and have that understanding and communication that if this is what you are seeing for the first time, we want to have a conversation with you, as this should have been announced to you prior to, your thoughts on making investment moves or changing your goals and objectives due to, the uncertain times or the volatile times. Because circling back to what Bill had said earlier in talking about some unique surprises in terms of our economy, one being, the stock market has been brought back in record times, low interest rates, which are very advantageous for refinancing and lending right now, both on the business and the personal side. But also highlighting that our household savings rate has increased dramatically in a year of a pandemic, as well as personal income. So with those 2, savings and personal income, if you don't have an understanding of what you need to be doing with those, we'd like to help educate you and put you on a path to achieve those goals and objectives that you may have. Myself, personally saving, throughout the pandemic, but also there are some strategic buying opportunities or strategic saving opportunities while interest rates are low, not achieving, similarly in a savings account or a deposit account for your institution, there are strategic areas to achieve more interest rate than what may be available for you. And, briefly speaking today, and the highlight was on Bill to, display his knowledge in the economy, I would like to follow up with an opportunity for all participants on this call today to also be able to dial into our perspectives on the market next Thursday, September 17th from 2 to 3 o'clock. Similar review of the economy. However, it is aligned more personally to our clients, but it is available to those that are not our clients to dial in and listen to our Chief Investment Officer as well as our economic advisors talk to staying optimistic in uncertain times. So in front of you here is a way to register, as well as if you utilize that link or register on our website, we do have the availability following the next page with all of our contact information. Again, my name is Michael Stark. You can reach out to me directly in an email, and I can make sure you get that registration, as well as set up a one-on-one appointment to talk a little bit more briefly in terms of what your needs and objectives are. But save this time now for some questions that I see have come in to you, Bill, over the time, and greatly appreciate everyone's time again and being able to speak today.
All right, great. We do have a couple questions that have come in, and I will just throw them out to our panelists on the call here. First, thank you, Bill and Mike, for the presentation. I personally, I feel a little bit better and a little bit worse, but thank you for the information.
You feel how I feel now.
Yeah, I don't know how you sleep at night with all that in your head, but yes, thank you. So for our first question is, how will the outcome of the upcoming election affect your forecast?
It's a great question. It's one we think about a lot, and it's one that we also approach with humility. I don't feel like I have enough information in hand right now to know how know how the election will affect the economy. A point that I would just make is that as important as the outcome of the presidential election, probably more important is the outcome of elections across the country for congressional seats and for senators. And I think I just don't have a read right now. If there ends up being a change to a Democratic Party majority in the House and Senate, will the new freshman class of senators and Congress people, will they pull policy to the center, or will we have a much more of a shift left in economic policy? Not really knowing the exact composition of it, it's very hard to call. I just kind of point out that not only over the course of the Trump administration, but also over the course of the Obama administration before it, many important economic policies came down to, votes of single senators, often the moderates, Susan Collins or John McCain's vote on healthcare is the famous example. They're just, I don't feel like they're easy to anticipate coming into election, prior to the election. So I guess my advice is watch the election. It's of course very important, but I don't think we're in a place where we can really draw strong conclusions yet about how it'll affect the economy longer term.
Do you have data on the percentage of people being retrained for new skills and how that might affect the economy?
Great question. That's one where I do not have a high frequency data source, or a high enough frequency data source that I would know how to monitor that, how that's changed since this recession has begun. It's one of those where we know it's very important, but we don't have good ways of measuring it in real time.
A person in the chat box said that she reduced her 401k contribution significantly at the beginning of the pandemic. Would you all recommend that she wait until after the election to restore it, or do so more quickly?
Mike, do you want to handle that one?
Yeah, that would be great. And the great question is, and I explain this even to my wife, and not to make fun of her, but explain in a way of clearance shopping, right? So what you're buying or what you're contributing to your 401k is a gamble. You're entering into the market, and there's some unforeseen reasons there. But if your personal time horizon is long enough to hypothetically say you're not retiring next year, probably within the next 3 years, it's safe to say that the influx of your savings is better to be growing tax deferred and compounding interest in a retirement vehicle rather than coming out in a paycheck, paying tax on it, and then being used as disposable income. So you have the opportunity to manage your cash flow efficiently by keeping the contributions into your 401k. There are some great buying opportunities out there right now, and would encourage you to maintain what you have and not respond to, the pandemic. So it's a question that I can take outside of the panel. If you want to talk one-on-one, you're more than willing to email me and we can talk independently about that for you personally. But it all comes down to time horizon, as well as what your goals and objectives are for that retirement vehicle.
Great, thank you. I don't have any more questions here, and we are just at our tidy hour. I thank you all very much. I thank PNC and all of our panelists. I thank all of our attendees today, and the Connecticut MGMA for putting the program together for us. I thank all of our collaborative states for joining us today, and we will be back again next month for another webinar. I hope you all have a great weekend and stay safe. We will see you again next month.